Everybody wants access to a great company before it becomes obvious. That's the dream, right? You find the next Amazon before Amazon takes over the world. You buy the next NVIDIA before everyone suddenly becomes an expert on computer chips. And then you sit back while your tiny investment turns into a number that makes your banking app look broken. That dream is exactly why investors get excited when a famous private company starts talking about going public. Finally, the velvet rope comes down. Regular people get invited in, and for the first time, you can own a piece of the future. At least, that's the sales pitch. But before you rush through that door, you should probably check who's walking out through the other side. Because an IPO doesn't magically create ownership, it transfers ownership. New investors come in. Existing investors finally get liquidity. The company may raise fresh capital. Employees might eventually sell shares. Venture funds can start planning their exit. And none of that is automatically bad. But it does create one very uncomfortable question. Are you getting early access to the company's future? Or are you providing a convenient exit for the people who already captured most of its growth? That difference matters a lot. And with enormous amounts of money flowing into artificial intelligence, it might be one of the most important questions investors can ask right now. When a company goes public, you'll see the exciting stuff. The executives ring a bell, employees cheer, financial television puts a giant stock ticker on the screen, and someone, somewhere, explains that this company is about to change human civilization. What you normally don't see is a venture capital spreadsheet quietly celebrating in the background. Private investors have a problem. They can own shares worth millions or even billions on paper, but paper wealth isn't the same as cash. They can't always click a button and sell their entire position on Tuesday afternoon. An IPO can help change that. It creates a public market for the shares. It can raise money for the company, but it may also create a path for early shareholders to eventually sell. The SEC itself warns investors to examine future share sales and lockup expirations. When restricted shares become available, a sudden increase in supply can put pressure on the stock. The SEC also notes that early shareholders may view an IPO as a way to realize returns on their investments. Again, this doesn't mean every IPO is some elaborate robbery. A founder selling part of a position doesn't prove the company is doomed. Maybe they want diversification. Maybe an employee needs to buy a home. Maybe a venture fund has to return money to its investors. That's normal, but the amount being sold, the valuation being requested, and the story being used to justify that valuation, that's where things get interesting. Because there's a massive difference between saying, we're raising money to build the business, and saying, we'd like the public to value this business as if the next 15 years have already gone perfectly. This is the mistake investors make over and over again. They ask, is this a great company? But that's only half the question. The other half is, what price am I paying for it? A beautiful house can be a terrible purchase if you pay 3 times what it's worth. A fantastic restaurant can be a bad business investment if the valuation assumes every American will eat there twice a day. And a revolutionary technology can produce disappointing returns if investors pay a price that already assumes total domination. The internet really did transform the world. That didn't stop internet stocks from collapsing during the dot-com crash. The companies weren't all fake. The technology wasn't useless. The underlying trend was real. The problem was that investors mixed up 2 completely different statements. The internet will change everything, and every internet company is worth whatever price the market gives it. Those statements are not the same. One became obviously true. The other destroyed a lot of money. That's why the most dangerous investment stories often contain a giant piece of truth. The story works because the technology really is impressive. Then enthusiasm takes that truth, puts it on an energy drink, and sends it running several miles ahead of reality. Let's be clear about something. AI isn't just a slideshow created to impress investors. People are using it. Businesses are adopting it. Developers are building with it. And it's already producing measurable productivity improvements in some kinds of work. Stanford's 2026 AI Index reported that organizational AI adoption reached 88% in 2025. It also highlighted measurable productivity gains in areas such as customer support, software development, and marketing. So, no, the argument isn't that AI does nothing. The more interesting question is whether AI can produce enough economic value quickly enough to justify the mountains of capital now surrounding it. Because the money pouring into this industry is enormous. Stanford reported that U.S. private AI investment reached approximately $285.9 billion in 2025. That was more than 23 times the corresponding private investment reported for China. And private investment is only part of the story. There are chips, data centers, power contracts, networking equipment, cloud infrastructure, research teams, and enough electricity demand to make utility executives wake up feeling popular for the first time in their lives. The spending can make sense if AI becomes a foundational layer of the global economy. But when expectations are this high, pretty successful might not be enough. That's the weird part. At a reasonable price, a company may only need to perform well. At an extreme price, it needs to perform almost perfectly. No major delays, no brutal competition, no collapsing margins, no cheaper substitute, no regulatory disaster, no customer revolt. And apparently, no engineer in a garage discovering how to do the same thing for 98% less money. That's not a business forecast. That's a wish list. Consider what happened with OpenAI's private market funding. In March 2025, OpenAI announced a $40 billion funding round at a $300 billion post-money valuation. By March 2026, it announced substantially more capital at a far higher valuation. OpenAI said the completed round involved $122 billion in committed capital at an $852 billion post-money valuation. Those numbers tell us investors believe OpenAI could become one of the most important companies on Earth. They may be right, but a valuation that large also creates a new problem. The company doesn't just have to build an excellent product, it has to grow into one of the largest corporate outcomes in history. There's less room for good. There's less room for successful. There's less room for we're still figuring out the business model. Once expectations reach that level, the company is no longer competing only with other AI labs. It's competing with the version of itself investors have imagined 5, 10, or 15 years into the future. And imaginary companies are difficult to beat. They never miss targets. Their costs always fall. Their customers never leave. Their regulators are extremely cooperative. And their profit margins look incredible because imaginary data centers don't receive imaginary power bills. This brings us back to the IPO. Companies don't go public because Wall Street suddenly decides ordinary investors deserve a gift. They go public because access to public capital can be useful. It can fund expansion. It can create a tradable stock for acquisitions. It can increase visibility. It can reward employees. And yes, it can provide liquidity for existing shareholders. The public investor needs to determine which of those goals is driving the offering. That information is usually more valuable than whatever futuristic slogan appears on the first page of the investor presentation. Look at the prospectus. How much money is actually going to the company? How much is going to selling shareholders? What will the company do with the proceeds? When do lockups expire? How much stock could enter the market later? Which shareholders retain voting control? How quickly are expenses growing? And how much of the projected opportunity is already reflected in the price? The SEC specifically directs IPO investors to review sections covering risk factors, financial condition, use of proceeds, and the company's business. Not exciting, I know. Nobody has ever opened a 300-page prospectus and yelled, "Cancel my Friday plans. This risk factor section is getting spicy." But that boring document may tell you far more than the launch day celebration. When excitement is low, buyers have power. They can demand better prices. They can ask difficult questions. They can walk away. But when excitement becomes extreme, the balance changes. Suddenly, buyers are competing with each other. Nobody wants to miss the allocation. Nobody wants to be the one person who passed on the next trillion-dollar company. And the seller? The seller can ask for more. This is why hot IPOs can behave strangely. The SEC notes that heavy demand can push prices sharply higher when trading begins, but prices may fall after that initial burst of enthusiasm fades. The first-day pop looks exciting on television, but if ordinary investors couldn't buy at the offering price, that pop may simply mean they're arriving after the easy money has already been made. It's like receiving an invitation to a party at 2:45 in the morning. Sure, you've technically been invited, but you should probably ask why everybody near the door is already holding their coat. So, should you automatically avoid every AI IPO? No, that would be just as lazy as automatically buying every one. The point isn't to replace blind optimism with blind pessimism. The point is to separate the company from the price. You can believe AI will reshape the economy and still reject a ridiculous valuation. You can admire a founder and still read the risk factors. You can love a product and decide you don't love the stock. And you can wait. That last option gets ignored because waiting doesn't feel intelligent. Buying feels like action. Selling feels like action. Waiting feels like you forgot your brokerage password. But the market doesn't award points for activity. Sometimes the smartest decision is to let a company report a few quarters of public results. Let the excitement settle. Let the lockups expire. Let management prove that the business can convert attention into durable cash flow. You might miss the lowest price. You might also avoid paying the highest one. The next wave of AI companies entering the public market could create incredible opportunities. It could also create some of the most aggressively priced stocks investors have ever seen. Both things can be true. So when the headlines arrive, don't start with, "Is this company changing the world?" Start with, "What would have to happen for this price to make sense?" Then ask who's selling. Ask what they're receiving. Ask where the new money is going. Ask how much future success has already been included in the valuation. And most importantly, ask what happens if the company becomes merely successful instead of becoming the most dominant business in human history. Because the biggest investment risk isn't always buying a bad company. Sometimes it's buying a brilliant company at a price that leaves no room for reality. Nobody knows which AI company will ultimately win. Nobody knows exactly how profitable this technology will become. And anybody giving you a guaranteed date for the next market crash is selling confidence they don't actually possess. But you don't need a crystal ball. You need patience. You need a calculator. And every once in a while, you need the confidence to watch an exciting opportunity walk straight past you. Because missing one winning stock may hurt your ego. Paying a fantasy price for an uncertain future? That can hurt your portfolio. If you want more finance without the shouting, the fake certainty, or the overnight millionaire nonsense, subscribe. We'll keep asking the boring questions. They're usually the ones that save the most money.